Assalamualaikum warahmatullahi wabarakatuh. Hello everyone. We are from Group 8. Now in here we're gonna talk about Chapter 4, Income Statement and Related Information. Before we gonna talk about the material, let us introduce ourselves. My name is Ramadhan, and then my friend.
My name is Indah, salsabila, oksalima.
Okay.
And I'm Khairunnisa, yumna, hanan.
Okay. That's all for our introduction. Let's talk about the material. Okay. For the first material about the income statement, and then the second one material about the content and format of the income statement will be explained by Indah. For Indah, time is yours.
Okay, thanks Ramadhan. So I will present about income statement. So the income statement is that report that measure the success of company operation for a given period of time. It provides investor and creditor with information that help to predict the amounts, timing, and the certainty of future cash flows. So useful now of the income statement. The first one, evaluate the past performance of the company. 2, provide a basis for predictive future performance. 3, help assess the risk of uncertainty of achieving future cash flows. Next. So the definition of an income statement are as follows. The first one, the statement does not include many items that contribute to general growth and well-being of a company. 2, income numbers are often affected by accounting method used. 3, income measures are subject to estimate. For example, one company in good faith may estimate our useful life of an asset to be 20 years, while another company uses a 15 years estimate for the same type of asset. I will talk about content format of the income statement. Elements of the income statement, there are 2. First one, income. Income is increase in asset, decrease in liability. The result in increase in equity. Other than those relating to contribution from hotels of equity claims. 2, expenses. Expenses are decrease in asset, increase in liability. The result in decrease in equity. Other than those relating to the distribution to holders of equity claims. Next. So this element of the income statement. The first one, sales of or revenue section. There's a present sale, discount, allowance, returns, and other related information. 2, cost of goods sold section. It shows that the cost of goods sold to produce the sales. There's a gross profit, revenue less cost of goods sold. Selling expenses is reports expenses resulting from the company's effort to make sales. 4, administrative or general expenses, report expenses of general administration. 5, other income expenses and expenses include most other transactions that do not fit into the revenues and expenses categories provided above, income such as gains and losses on sale of offline assets, impairments of assets, and restructuring charge are reported in this section. In addition, revenues such as rent revenue, refinery revenue, and interest revenue are often reported. There's an income from operation. It's a company result from normal operation. Next, so 6, financing cost is a separate item that identifies that financing cost of the company. Hereafter referred to as interest expenses. So income before income tax is the total income before income tax. 7, income tax is a short section reporting tax levied on income before income tax. Income from continuing operation. A company is a company's result before any gains or loss on discontinued operation. If the company doesn't have any gain or loss on discontinued operation, this section is not reported, and this amount is reported as net income. 8, discontinued operation. Gain or loss resulting from this disposition of component of a company. So there's a net income, the net result of the company performance over a period of time. 9, non-controlling interest. Interest is present and allocation of net income to the controlling shareholders and to the non-controlling interest. Then earnings per share is mean per share amount that are reported. So next, condensed income statement is some cash. An income statement cannot
Okay, thank you, Indah, for your explanation about the first material and the second material. For the third material, we talk about reporting various income items. We're going to talk about the gross profit and income from operation. From the gross profit, company gross profit is computed by deducting cost of goods sold from net sales. The reporting of gross profit provides a useful number for evaluating performance and predicting future earnings. Several readers may study the trends in gross profit to understand how competitive pressure affected profit margins. And then we will talk about income from operation. Company determines income from operation by deducting selling and administrative expense as well as other income and expense from gross profit. Okay, next. Okay, next we're going to talk about income before income tax. Income before income tax by deducting interest expense, often referred to as financing costs, from income from operation. And then we're going to talk about function of expense method. Deduct income tax from income before income tax to arrive at net income. Net income represents the income after all revenues and expense for the period are considered. Okay, next. Okay, we're going to talk about earnings per share. Earnings per share is net income minus preference dividends. Income available to ordinary shareholders divided by the weighted average or ordinary shares outstanding. Okay, we're going to talk about discontinued operation. Company report as discontinued operation, the gain or loss from disposal of a component of a business. In addition, company report the result of operation of a component that has been or will be disposed or separately from continuing operation. Okay, next. Okay, the last we're going to talk about allocation to non-controlling interest. Non-controlling interest is then the portion of equity interest in a subsidiary not attributable to the parent company. Okay, next. Okay, for the fourth material, we're going to talk about accounting change and error. For the first, we're going to talk about change in accounting principle. Accounting principle are certain principles, based rules and practice that an entity applies in the preparation of financial statement. Change in accounting occur frequently because important events or conditions may be disputed or uncertain at the statement date. Okay, we're going to talk about a company recognize a change in accounting principle by making a retrospective adjustment to the financial statement. Retrospective adjustment of a new accounting principle is the correction of recognition, measurement, and transaction events and other conditions as if the principle had been applied. In other words, retrospective adjustment is the adjustment of the last principle from several years before the application of the new principle. Okay, for example, from the change in accounting principle are a change in the method of inventory pricing from the FIFO to average cost. The company recasts the prior year's income numbers under the newly adopted method. Okay, next. Okay, for the next material, we will talk about change in accounting estimates that are an adjustment to the carrying amount of an asset or liability of the amount of periodic disposal of an asset that result from an assessment of the present status of an expectation of future benefit and liabilities associated with asset and liabilities. The effect of change in accounting estimates are recognized prospectively in the income statement. For the first, the period of change is the impact of the change in only on the period in which the change is recognized. And then the second one is the period of change and the future periods if the change affects both periods. Okay, for the next, for the last, change in accounting estimates result from new information or new developments and therefore not from the correction of error. Okay, next. The third one is the last, correction of errors. Errors occur as a result of mathematical mistake in application of accounting principle, or oversight or issue of facts that exist at the time financial statement. Companies correct errors by making proper entries in the accounts and reporting the correction in the financial statement. Correction of error are treated as prior period adjustment, similar to change in accounting principle. Okay, I think that's all for me. For the next material will be presented by Hanan. For Hanan, time is yours.
I will explain the fourth material related in equity statement. There's three things that are related in equity statement: retained earnings statement, comprehensive income statement, and statement of check in equity. Retained earnings statement is net income if net income increase retained earnings, and net loss decrease retained earnings. That means both cash and share deferred with decrease retained earnings. Change in accounting principle yearly and period adjustment may increase or decrease retained earnings. Companies charge or credit this adjustment net of tax to the opening balance of retained earnings. Restriction of retained earnings. Companies often restrict retained earnings to comply with contractual requirement, board of directors policy, or current necessity. Generally, companies disclose in the notes to the financial statement the amounts of restricted retained earnings. Next, comprehensive income statement. Comprehensive income include all checks in equity during a period except those resulting from investment by owners and distribution to owners. Comprehensive income therefore includes the following: all revenues and gains and losses reported in net income, and all gains and losses that bypass net income but affect equity. These items, non-owner change in equity bypass the income statement, are referred to as other comprehensive income. Company must display the components of other comprehensive on one of two ways: one statement approach or two statements approach. Next, one statement approach. In this approach, the traditional net income is a subtotal with the total comprehensive income shown as a final total. The combined statement has the advantage of not requiring the creation of new finance statement. However, varying net income as a subtotal is a disadvantage. Next, two-statement approach. Under the two-statement approach, the income statement requirement are the same as the first part of the single statement. The second statement, called the statement of the comprehensive income, start with profit or loss and then includes each component of other comprehensive income, net of tax, gross of tax, followed by a single line for the aggregate tax, check or credit. If there is no items of other comprehensive income, then the separate statement of comprehensive income may be excluded. Next, statement of check in equity. Equity in generally comprises of share capital ordinary, retained earnings, and the accumulated balance in other comprehensive income. The statement records the change in each equity account and in total equity for the period. The following items are disclosed in this statement: 1. Accumulated other comprehensive income for the period. 2. Contribution, issuance of shares and distribution, dividends to owners. And 3. Reconciliation of the carrying amount of each component of equity from the beginning to the end of the period. That's all from me.
Okay, thank you for Hanan about the 5 materials about related equity statements. And for the conclusion at last, we already talked about income statement, and then we already talked about what the purpose we need to provide income statement. For example, like to evaluate the past performance of the company, provide a basis for predicting future performance, and anything else. Okay, and then for the second material, we already talked about content and format of the income statement. before we provide the income statement, we need to know that what content and format from income statement. And then there are income, expense, and then we'll talk about sales or revenue section, and then COGS, or we call that cost of goods sold section, and then gross profit, sales expense, administrative or general expense, and anything else. And then for the reporting various income items, we already talked about what means about gross profit and how we can calculate gross profit, income from operation, income before income tax, function of expense method, and earning per share. And then for the for material, we already talked about accounting change and error, how we can correction of error in our financial statement or income statement. And then for the last material, we already talked about related equity statement. I think that's all for my group. Thank you very much for your attention, guys. That's all for our presentation. Wabillahi taufiq wal hidayah. Wassalamualaikum warahmatullahi wabarakatuh.